Hey everyone. Hi Ben.
Hi, how are you?
How are you doing?
Doing well.
Awesome. We'll just give it a few more minutes and get started. It's mostly what we presented last time, but we have more new people in the community. It's growing constantly, and then there were tons of really interesting questions that I've been getting when I'm having conversations. So hoping to add more clarity, and then we'll have time for Q&A on the back end also.
Wonderful.
How's your week been so far?
It's been great. We're staying busy. It's as you know, the end of the year rush. So trying to get
Yes,
everything done.
that's true. That's true. Fun times.
Yeah,
Are you doing anything fun for the holidays?
pretty low key.
Oh,
Trying to wrap up the year well, and then yeah, just hanging out, kind of that week between Christmas and New Year. Really
yeah,
looking forward to that.
yeah, I hear you. I can come back to this. I'll just give it a few more minutes. Let's say hi to whoever's on here. Hey, Tom, thank you for being so patient. I know you've been waiting for a while. We're going to get started in a few minutes. Hi, Tiffany. Hey, Bill. How's everybody doing? Um, okay, super excited, guys. We'll have the same format as before. Just feel free to drop your questions in the chat as we go through this. And if you're listening to this on Facebook or any of the other channels, again, feel free to drop your questions in. Adrian, was that you? And I have a feeling everyone's set to be muted as we go through this, but I feel like we should be good to start in a few minutes. Tommy's on vacation, so he won't be joining us. I believe he's in Thailand at this
Oh,
time.
great.
So, yeah.
Wonderful.
Okay, awesome. Adrian, if we're good from a tech perspective, we can get started.
Live streams are good across the platforms.
Okay, excellent. Okay, guys. Thank you for being with us again. And I know we're streaming across multiple platforms, but for those of you who are catching the replay, just feel free to always, if this is on Facebook, drop questions in there, and we're more than happy to jump in and answer those questions, like always. And I want to thank Ben for being with us again. Ben's with the Crystal View Capital, and he's here to kind of help us deep dive into the deal and answer any questions all of you have. We are going to start off with what we typically do, where we're going to go over the return profile. We're going to talk about the opportunity, the tax advantages, what the business plan is, all of that good stuff. We'll talk about timelines, next steps, and then we'll have tons of time for Q&A on the back end. So, for some of you who are new to the space, if it's related to the terminology or if it's about the business plan specifically, or if it's specific to the fund per se and the timing of us getting in. I know a lot of you have had questions about how things work out, as we enter the fund and more questions about the exit. Just drop all of that in the chat and Ben and I will take it as we go. But as always, guys, disclaimer, a lot of these returns are projected returns. We will talk today about historically what returns have looked like for this niche for Crystal View Capital, and we'll talk a little bit about our portfolio and our returns. But know that the numbers, again, we do a very good job of being very conservative as far as the return profile goes, but they are all projected returns. And make sure you're talking to your CPA and your attorney as you're trying to plan in terms, especially in terms of from the tax perspective and what entity you're using to enter and invest in, because a lot of this is personal. So make sure you're talking to your advisors. But that being said, most of you know me. I know we have a few new people in here. So for those of you who don't know me, I'm Param, radiologist in Southern California. I founded Generational Wealth MD and the GW community. We are 20,000, members strong at this point, and the whole point is to educate around investing in alternative assets. So, I got to financial freedom at 41 by investing in real estate, and it's essentially paying it forward and helping others break barriers to investing in alternative assets. At this point, we have over 530 million in assets under management in partnership with our partners. That's over 2,900 doors, and that keeps increasing. So I feel that number is pretty close to where we are at this point. And again, if you're looking at our slide deck or if you're on our website, you will see what our current portfolio looks like. But a big focus has been education. And so I will be sharing some resources with all of you especially for those of you who are getting started. If you haven't taken a look at some of our resources, I'll be sharing that with you. And like I mentioned before, a big part of what we're trying to do over here is educate around investing in, outside of the stock market, essentially. So you are also participating in that asymmetric risk reward, where we're lowering risk in our portfolio and increasing returns. And I'm very excited about this opportunity with Crystal View Capital because it has a very unique risk reward profile compared to what we typically do. If you've invested with us before, or if you've listened to our presentations, a lot of what we've done in the past has been multifamily, single assets. This fund is unique. It's a diversified fund, and it is manufactured housing and self-storage. And so again, the focus is always on how are we lowering risk, how are we introducing diversification while we're increasing returns, right? So I'm super excited to deep dive into this. But that has been our mission. Just at a glance, this is what our numbers look like, and the deals that we've been in. For those of you who are relatively new to the space, to investing passively in real estate and alternative assets, the guide is, I call it a labor of love. I put a ton of time and effort into this, and it helps someone who is new to the space, or even if you have been investing, it helps you get clear about kind of really knowing what your buy box is based on your goals and your resources. And it also walks you through vetting the market, doing deal and sponsor due diligence. So if you haven't taken a look at it, go to gwcapital.com/guide and download that. And again, I want to thank everyone on here, everyone in the GW community. All of you make our charitable mission possible. Tommy is not with us today. He is vacationing in Southeast Asia, but I'm excited to have Ben with me as we go through the opportunity again. Some of you probably were on our first webinar, but we're going to go over the deal per se, and then we'll field all the questions you guys have. Ben, super excited to have you on here. This is you probably heard me say this. It's probably been close to a year that we've been doing due diligence, with Crystal View Capital. I'm super excited for the timing of when we're entering the fund, Ben. But if you could take a minute to just introduce yourself to those on here, some of them are fairly new, so and probably haven't watched our first webinar. Just give us a little bit of an overview about Crystal View Capital and the business model, and then we can start deep diving.
Absolutely. Well, thank you so much for that. Really just grateful for this partnership. Like Param mentioned, we've been working on this for, yeah, a long time, months and months and months, almost a year now. And just grateful for the relationship and where this has gone. Crystal View Capital, we've been in these asset classes, so manufactured housing, so mobile home parks and storage facilities. For the past 20 years, we've been doing that under the fund umbrella, the Crystal View fund umbrella for the past decade. We're in 31 states. Now, we're a fully vertically integrated shop. What that means for us is that the vast majority of our deals are sourced off market. So while we do see what the brokers are listing all the time, over 92% historically has been purchased off market. That gives us premium pricing, and there's some unique benefits that gives us that we can go into the weeds on later on. Um, all property management is in-house. That's very, very important to us. We are a value-add player. And those on-site property managers are our W-2 employees. We have full control over those assets. That's very important to us. Very important to know what's going on a daily basis at these assets, and to just have ultimate control, to bring that risk profile, like Param was talking about, down, because we really do control every dial and all the levers there. So what we're doing is we're buying from mom and pop generally. We assemble large portfolios, and then we sell these after a handful of years in large batches, generally upstream. And we can talk about what that looks like, but those are institutional buyers normally who purchase these assets when they're hyper efficient and running smoothly. So that's what we do. I lead our capital formation and investor relations team here at Crystal View and try to keep everyone happy along the way.
Yeah, I love that. And I think that's what's unique. Well, quite a few things are unique to this fund as opposed to the assets we've gone in previously. We've been in single asset, deals before. This one, like you said, you're in multiple states, multiple assets, and so it brings that diversification. But the business plan, I think, is unique. We have some case studies of actual assets within this fund that we're going to talk about later, where you can see how vertical integration, property management being in-house, and off-market acquisition really helps with boosting the NOI. Super excited to go into that. But I wanted to, if it's okay with you, Ben, talk a little bit about the space per se. I feel like we've educated around multifamily so much, and this is a new niche for many of our investors, and I'm excited about it. So we'll just talk a little bit about the supply demand dynamics, what the demographics look like and what's shifting as far as both the manufactured housing space and self-storage. And as we go into this, and some of you probably already know this, but in the pipeline, and correct me if I'm wrong, we're really hyper focused on manufactured housing at this point for a future pipeline for the fund that we're entering, correct, Ben?
Yeah, that's right. That's right. Yeah, nearly 80% at this point, as of today, 80% of the portfolio is manufactured housing versus 20% storage.
Yeah. And so, Ben, walk us through. I want to talk about self-storage later. I just want to start off with manufactured housing because that is going to be the focus of the fund, and it's going to be the bulk of what's in the fund. Let's talk a little bit for people who are on here about, what the and this is what I love, right? The supply demand dynamics in the space is very, very unique. But let's talk a little bit about that housing affordability and how this is actually a niche that I feel like, for anyone should be excited to own, to own this asset class at this point.
Yeah, that's absolutely right. So it's no surprise to any of us. We're in a full-blown affordability crisis in the nation when it comes to housing. It is very, very challenging for a lot of us across the United States to find a long-term place to live. Um, and manufactured housing is the most attainable rung on that affordability ladder. Now, the quality of houses that are coming out, these pre-built, pre-manufactured homes, because of the technological advances in the space and in building, it's really quite substantial. These houses can be quite nice, and you can spend a lot of money on a pre-built home. Now, the vast majority of folks across the country who are in these parks don't. But if you want to, you could spend $500,000 on a pre-built home. Some of this technology is really, really nice. There used to be a stigma in the space that, for lack of a better term, trailer trash, right? There was, Uncle Johnny rolls his trailer up, and that classic picture that people think of. Well, that couldn't be further from the truth. A lot of these communities, and we'll get into some of these examples later on, really just they look like normal neighborhoods, right? There's nice skirting around this thing. Now, our tenants own their actual house itself, but and that gives us some wonderful ability to have great relationships with our tenants. It's a higher quality tenant. We really like the people we work with, and they really want a nice lifestyle for a relatively affordable cost, right?
Yeah.
They own their home, they're renting the pad itself. Now, there's also a supply demand dynamic as far as building new parks. While the stigma is gone for a lot of folks and they're moving into our communities, um, uh, it is really hard to get the zoning to build these things, right? There's this idea of NIMBY or not in my backyard. Governments have really created this very challenging dynamic to build this stuff new. It's also cost prohibitive to buy the land and set this out. So there's a limited supply. Generally, over 60% of the market, even still today, is owned by mom and pop. They've owned it for over 20 years, generally on average. So we have quite a bit of opportunity here. You've maybe heard of the silver tsunami with small businesses, of these business owners selling their business, the greatest transfer of wealth that the United States has ever seen. Well, the same dynamics apply here to manufactured housing communities, right? So we love this asset class. We'll get into some real practicals here later on. They're a sticky asset class, right? There's very, very low turnover because these people own their homes. It's about ten to $15,000 on average in the states that we operate in to pick your house up and move somewhere else. And so you generally stay put. You know your neighbors. There's some great opportunity there.
Yeah, yeah, and it's like, you highlighted all those key points, but in multifamily, what we're seeing right now, what's affecting occupancy, what's affecting, rents has been like a glut of supply. And I mean, just owning something where there's very, very limited supply really affects that dynamic. And housing affordability, we've talked about this in a lot of our state of the markets, right? It's like it's one of the times where there's a housing affordability is at its worst. This kind of solves as a solution to the problem. Love the fact, like you mentioned, these people own their homes, so there's very sticky tenancy. A lot of these slides kind of go over those same things, right? Housing affordability and in terms of overall demand in the country, there are a lot of data sources which say we're at a shortage of anywhere from 4 to 10 million homes that we require across the country over the next decade, right? And all of that plays into, so in a sense, it is one of those essential classes where it is residential housing, right? And so that really does affect the numbers in the long term. Sorry, Ben, I think you were going to say something.
Well, yeah, so we really have not recovered housing wise from 08, 09, right? That bottomed out really in 2012.
Yeah.
But that really just wiped out the home builders and the new home builders, the starter home builders in the United States. They either pivoted to the $1 million plus home or they just went out of business. And now the groups that are still building those kind of entry level homes, there's really four of them. And there is a massive supply shortage here. Now, what we're seeing, because we've been doing this for 20 years, it used to be a lot of blue collar workers who lived in our communities, and we love those folks, right? It's the people who are living on pensions as well. So that think the pipe fitter. We've got a lot of teachers who are living on pensions who are in our communities. But what we're seeing now is something really interesting, really since COVID. There are two demographics that honestly we have been surprised to see flood our parks. Now we're predominantly in the Midwest and kind of upper Midwest. We can go into that more a little later on, but it is millennials and it is boomers who affordability really matters to these people, right? So let me start with the boomers. These are people who saved their entire lives into their 401ks, their IRAs. And during COVID, they decided, hey, I'm just going to retire. I'm going to retire early. I'm going to retire now, or maybe right after COVID. But with inflation, just affordability for these people, the cost of groceries, the cost of putting gas in your car, things are tight, things are skinny. Now they're looking at the equity that they've built up in their home and they're looking at the lifestyle they thought that they could have in retirement. And they're saying, hey, I'm going to sell my house. I'm going to cash out. I'm going to buy a nice 70, 100,000, $150,000 pre-manufactured home.
Yeah.
And I am going to travel. I'm going to travel 2, 3 months out of the year. I'm going to go see family. I'm going to go see Europe and see the world. And so we've got a lot of those people who are coming into our communities. Now, the millennials, this is an interesting thing as well, is you've got millennials who are even, they're great earners, right? They've got the ability to earn a decent amount
Yeah.
of money, but they're looking out and they're seeing that average home cost being $500,000. They're tired of renting.
Yeah.
Underwriting standards have drastically increased here over the past 15 years. And what do? Right? They care. Millennials generally want certain things in life and they prioritize those things
They do.
over others, right? Maybe they want a nice car. Maybe they want to travel first class. I don't know what it is. But these people are tired from the annual kind of yearly lease, even if it's in a nice apartment complex, and they're choosing to buy a nice mobile home and move into our communities. We've been surprised by those two demographics.
Yeah, that's just remarkable, right? I mean, and there is a huge difference. It's a average home price for the manufactured homes is around 120K versus 400K for single family homes. And it's not just the cost of the homes that have the prices having gone up, it's also the interest rates, right? Those two things together just, affect affordability significantly. And yeah, so all of this, I mean, a lot of this plays into people wanting to rent because there's a gap over there, but also for people who want to own, then it makes, these manufactured home parks and these communities definitely way more affordable. I'm just going to skip through some of this because I feel like we've discussed some of this, the housing shortage we talked about. Let's talk about self-storage, Ben. Again, over here, we're seeing a steep drop in supply hitting the market. So again, a resetting of that demand-supply dynamic in self-storage. But let's talk a little bit about what you're seeing in terms of changes in the demographics as far as self-storage goes.
Yeah, yeah. Well, let's just cut to the quick of it. The REITs have kind of obliterated this space. All right. So these publicly traded REITs are flush with cash. They basically they have stocks, right? And they need to hit a 4 or 5% yield. So they can come in, they're flush with cash. People keep investing in REITs, buying this stock basically. So they've got a bunch of cash. They go and they overpay for product. They can sit on low occupancy and they can drive rents down. Right. So what that's done, and they can build new in markets that are oversaturated because they just need to build and they need to clip that 4% yield. So they can do that. They've done that in major metro areas, right? So for us, we've really pulled out of the Dallas,
Yeah.
Denver areas, Seattle, Phoenix is a great example. We don't play in those areas anymore. We're really in secondary and tertiary markets where we have a competitive edge. So we still love the asset class. The fundamentals that have been there for the past 20, 25 years are still there, right? Fantastic asset class. Incremental rate increases, when you have a tenant that's there that's not paying rent, you can put a bolt on that really quickly, and just a great
Yeah.
asset class. However, on the pricing, on the purchase really, really matters to us. So narrative matters more than it ever has before on what you're picking up. Location matters more than it ever has before. So we still love it. The market dynamics are still there in certain markets, but those are going to be secondary and tertiary markets. We'll have some examples that we'll get into that really showcase that.
Yeah, I love it. And even in that, what your what Crystal View's been able to do is to go in and bump up NOI just because of the business plan, and that's unique. But being a multi-asset fund, you also have the ability to pivot as those demographic shift. And in the pipeline, we really don't are not seeing a lot of self-storage at this point, and you have the fluidity and the ability to do that.
That's exactly right. Yeah. And this also comes back to the buy and who we're buying from, right? So finding these things off market, we're buying from mom and pop. The assets that we have purchased right now that are in the fund on the storage side have all been off market. Those have all been mom and pop.
Yeah.
And these are people who they tote, I'm 100% occupied. Well, on the
Yeah.
storage side, something's wrong if you're 100% occupied, right? You're
It's
not you're
true for
not
multifamily too.
pushing rents enough, right?
Yeah.
So we know, hey, that's a good sign. We can come in and add some value here, and then we're doing some creative things as well, putting solar on roofs of our facilities and
Yeah.
things that are generating some extra income there.
Love it, love it. For those of you who are listening, I just want to, for those of you considering the difference between REITs and syndications and funds like the ones we're talking about, REITs typically tend to be very tax inefficient because you have to pay marginal taxes on the distributions that they send out, and there are multiple layers of fees, and I believe average returns typically are anywhere from 8 to 12%. And so we're talking about when we go through a fund like what we're doing, this structure, very tax efficient. We'll talk a little bit more about the tax breaks on the back end, but it's very tax efficient income and gains on the back end, right? And there are ways for it to keep being very tax efficient and keep deferring your taxes, but also significantly higher returns than what you would see with REITs if that's a question that's coming up for people. But um, I just want to move on. Ben, do you want to talk a little bit about the specifics of the fund, and then I'll just go into the return profile after this?
Absolutely. Yep. So 24 assets as of today. You can see the numbers there, but here's what's important. We're cash flowing. Right. So the NOI of this fund is very, very strong.
Yeah.
We are cash flowing. We're paying out the full preferred return to our investors. This is pretty early on in the fund to be able to do that. And that just speaks to the value add that we were able to bring to the table in the early days of owning each one of these assets individually. So we are about halfway through our deployment right now. We'll probably buy another 20 plus assets into this fund. So some significant value left to get here. So you're kind of coming in at the optimal time where you get the it's de-risked in a sense, right? Because
Yeah.
you've got a base of 24 assets, it's cash flowing, but then those assets that we hold today, we continue or will continue to appreciate in
Yes.
value. We'll continue to do our business plan there, but we're also going to buy. We're going to double our footprint here.
Yeah.
So we're excited about where we're at today.
Yeah, and we're excited about coming into the fund at this point because this is, typically a 10-year fund. We're coming in. This is what year two and a half, three mark, Ben. And so what, and like Ben was saying, we're at the point of the fund where for us going in, we're going to hit preferred returns day one because the fund is already cash flowing over 9-10%, right? And so it's a very, I mean, in my opinion, it's a great point in the fund to be entering, and we're excited about that. And want to quickly deep dive into the return profile because I think for people who are used to multifamily, it's nice to take a look at. We talked a little bit about how the risk profile is different, right? With all the diversification, multiple assets, multiple states, the geographic diversification, all of that really helps from the risk profile part, but I want to go into the return profile just so you can see how it's similar and how it's still very unique and different compared to what we typically see in the single asset multifamily space. And so as always, and our goal always with GW Capital is for us to go in and see how we can bump up returns for our investors just because of the community size, because we go in collectively. We were able to do that, and we are able to do that because the fund gets paid at a higher pref and the fund gets higher splits, and we're like always, our goal is to pass it on to our investors. And so when you go through GW, again, like I said, like Ben and I were talking about, if you're in Class A and that's for investments from 50 to 250K, you're starting off hitting that preferred return from the first distribution, right? And distributions are going to be quarterly. So, and correct me if I'm wrong, Ben, the first check, we should see that coming in January, and you will be hitting preferred returns at that point, right? And so we are giving an enhanced profit split for our investors. So GW investors, the profit split goes from 60-40 to 65-35, and so that's beneficial. For the next class up, we've lowered the minimum to 250, and that's again something we like to do. So we are able to share that enhanced economics with our investors. And so once you get hit to the 250 mark, and so that's lowered from a 500K minimum, right? And same thing for the Class C, we're lowering that from $1 million minimum to a 500K minimum for you to get an enhanced profit split, right? And so again, I think what we love about this is that if you're, say, if you're a Class C investor, you're hitting 8% preferred return from day one, right? Or if you're a Class A investor, you're getting that higher return. And I think this is one of the ways where it's different from what we're seeing in multifamily, just with interest rates the way they are and the basis we have to go in at this point. We're probably, and we've entered, I would say this year, we've gotten into 3 assets, multifamily assets, and we've stuck to assets that are at least cash flowing 5% day one. It's really, really hard to come by those assets in the multifamily space. And so knowing that, you can see how unique this fund is going to be with the higher cash flow day one, right? And when we get to the exit, and maybe we should talk about this, Ben, can we talk a little bit about like knowing that we're going in around in the third year of the fund? Let's talk a little bit about that exit and when they can see. And so this is, guys, this is what your projected IRRs, and Ben knows this. We've kind of muted this a little bit just because we want to be very conservative. But projected IRRs and your average annualized returns are also significantly higher than what we're able to even project in the multifamily space. A lot of that has to do with the unique business plan that Ben was talking about, right? The ways they're going in, adding value and bumping up the NOI. But Ben, if you could walk everyone through the exit, when they can expect to see, because it's a multi-asset fund, the exit is also unique, right? When they can expect to see return of capital and the profit splits, what that timeline looks like.
Yeah, yeah. So let me put an asterisk here. You all know this. We've talked about projections here. So everything on the
Yeah.
screen is projected. We're trying to be
Yeah.
conservative in how we display this, but they are projections. There are assumptions here, and that's the same situation for our estimated timeline. It is
Yes.
estimated. Now we're pretty confident in this, but we're shooting for it, so it's estimated, right? So if we're looking at the fund as a whole, so roughly the first half of the fund, we're raising capital for the first year or 3 years. We're buying assets. We will recycle capital back into the fund. So if there's an early sale or a refi, and say before year 5.5, then we'll take those proceeds and we'll continue to buy more assets, right? Scale really matters to us because what we're doing is we're assembling these, we're rolling these up and really trying to sell them to institutions. And so scale matters. We want to bundle these up in mass, get them hyper efficient, and sell them in large pools or portfolios. So first 5-ish years of the fund, which we're about 3 years into, so about 2 years remaining, we're buying assets. When you get into year 5, so 5.5, year 6, we're really returning capital to you. So there's going to be likely refinance proceeds, maybe a sale or two that happen that's going to generate proceeds that's going to go back to give you a return of capital. And then all the assets that are remaining, we try to, in a quick and consolidated fashion, as much as we can, and it is a little chunky, we try to batch those up and sell those off, right? And so that comes, if you're looking at the screen here, that really comes in year 6, year 7. Now we have this modeled out that everything's happening here at the end, just to be conservative. It bodes well for you if the return of capital and everything is actually a little bit more compressed and comes a little earlier for you, but we want to be conservative in how this is reflected. So it's really in year, if you're looking on the screen, 6 and 7, um, and those would be kind of the profit or net profit portions that would come back to you.
Yeah, perfect. Thank you for explaining that, Ben, just because that's again, that's another distinction between what you see with a single asset that we hold and, exit, and you get, your bulk of your return of capital and profit split on the back end. It's going to look a little different for this. Ben, maybe this would be good for you to take. I just wanted to also include, just from the perspective of track record, right? This is what Crystal View's previous funds have looked like in terms of their IRRs and the multiple on
Yes.
invested capital. Again, like Ben said, um, everything is projected, right? And so we want to be intentional about that, but it's also important to know what the track record looks like. So if you, I can linger here for a little bit, Ben, if you want to
Well,
talk
yeah,
about this.
I'd love to speak to this. So Fund One has gone full cycle. Now these are net to the funds themselves. That's important to note. These are not to individual investors. This is net to the fund. But what's been realized on average is 70% IRR for Fund One. Man, it was a great time to buy assets. That was a 2014 vintage. Some fantastic timing then. That has gone full cycle. 46.9% IRR at the end of the day there, which was just fantastic on that one.
And that's to
But
investors, right, Ben? The
well,
46.9.
so different share classes there. So yeah, there's 6 different share classes in the fund. So that's going to filter through different share classes. Fund 2 and 3 are still in operation. So the numbers that you're seeing here are assets that we have sold, and the IRRs that we're striking and MOICs on that. You can see our average across the funds, but 2 and 3 still in operation. We're winding 2 down right now. Fund 3 is in year 5, going into year 6. We sold 4 assets out of that one. So about time to really start gearing up to sell more assets in bulk out of Fund 3.
Thank you, Ben. For those of you who are relatively new to the space, just wanted to explain the IRR and multiple on invested capital. Guys, IRR is like your average annualized returns. When you talk about stock portfolios, we say 10% annualized returns. That's every year. That's what you can expect. IRR also factors in time value of money, so it takes into account the fact that capital's returned sooner versus later during the hold period, right? And so, I mean, I guess that's so when you have a fund where you are getting batches of return of capital and splits, before the last date, it boosts your IRR because it does factor in when you have that the returns coming back, right? So that's IRR. Multiple of invested capital, that's the same as equity multiple. So which means 3.4x means if you put in 100,000, end of the day, at the end of the whole term, you have 3.4 times return to you, and that's what it is. And so very, very basic metrics, but for those of you who are relatively new, just wanted to make sure we touched upon that. Okay, with that being said, just like let's talk a little bit about the business plan and why we love this deal. Usually we like to do this. We break it down into what we like about the market, what we like about the deal per se, and the business plan. So this one's a little unique. We talked a little bit about the being vertically integrated, actually having in-house acquisitions, which allows, I guess the numbers are close to 90% being off-market acquisitions, right, Ben,
That's
in the
correct.
funds. Yeah, and so that vertical integration we touched upon a little bit, and all of these are unique to the business plan. I'm going to pause here, Ben, see if you want to add, add a little more color to anything, or we can move.
Yeah, well, I'd like to. We've talked about the cash flow. We've talked about our track record. I'd love to talk about Matt. I wish Matt he's traveling right now. I think he's on a flight. But our founder, Matt Riccadella, he's done this his entire career, these asset classes in particular. And he really believes in what we're doing here. Matt invests as an LP in the fund. Sometimes these funds, these big funds, they carve out fee breaks. The GPs carve out fee breaks for themselves. They set up a GP share class. They'll cash out their initial equity with other investor capital later on. It really is tragic. That's not what Matt's doing. What Matt's doing is he's investing as an LP, and so is our investment team,
Yeah.
by the way. I'm invested in this deal. We've got our staff who has invested in this deal. I mean, our administrative staff is pooling capital to come into this. So we really believe in this product. Now, Matt has over $15 million across two, three, and four here. He's committed to over five in fund four. He's over 2.5 today, where we sit. It's nice to be at a place where your founder believes in it so much that he's coming in as an LP, and I think that speaks volumes.
Yeah, and that's such an important point, right? So, are we co-investing with our investors is a valid point, and I love that. All the operators we work with have a similar philosophy, heavily invested in all our opportunities. I personally have 7 figures across our portfolio and 6 figures going into this opportunity, and so I think that just speaks to our faith in the business plan and to your track record also. Um, Okay. Did you want to go over anything in terms of markets? I know we've talked about the geographic diversification over here. Anything you want to highlight from the market perspective?
I'll speak to this quickly. If anyone has questions later on, we can
Yeah.
get more in the weeds. But we really are targeting the Midwest and the Upper Midwest in specific. Now, technically, we're agnostic when it comes to geography. Now we do look at locations differently, and we risk rate those locations really by zip code differently. So we're taking into account political risk, right? What's the political climate in the state? Is there rent control? Is there not? How would that affect us on the storage side, on the MH side? We see all that very differently. We know those things going in within our underwriting. We're looking at that. Also, insurance risk. This is huge these days. States like Florida, we've been in Florida. We're in Florida in some of our other funds, not Fund 4 right now. But our stance is becoming more and more, it's not quite there, but more and more, Florida might be uninsurable here pretty soon. Very, very difficult for insurance in Florida and some of these Gulf states. But if someone offered us an asset for $1, if the pricing was right, we probably wouldn't say no to it. So it's a risk return equation for us. But you've got a risk rate, right? You've got to take that into account. Now, we're looking at population drivers, right? So, particularly when we talk about the majority of this fund being MH, where are these people going? Where are they coming from? Where do they work? Are they retired? What's going on? So we're really looking into those demographics, income levels, all that stuff in various states. We talked about the secondary, tertiary equation. That's more so on the
Yeah.
storage side. But I think we kind of hit all these points there.
Sounds good. Sounds good. And I think we covered some of this, the high cash flow. We talked about vertical integration, the acquisition, and the diversification. We did touch upon the cash flow, which I think is something that's really unique, and it's also a buffer, right? So you're going into something where you have a buffer, and if things go wrong, you have a buffer. And the high cash flow is always something we're looking for in any asset we go into. Um, I think we can move on, right? We've talked about the cash flow numbers. Let's talk. Is there anything in terms of I do have some case studies, Ben, and those are from the actual assets that we went over last time within the fund. We can talk about the business plan there if you want to. If you want to pause and talk about value add, we can highlight something. Leave it up to you. Do you want me to just move on to the case studies?
Well, let's I'd love the case studies, but let's go back. Let me talk high level and then let's get into the case studies because on the MH side, we're really doing some very unique things in the field. Now, what we do, it's not super complicated, right? The most complicated angle of what we're doing is managing our 200 plus employees across 31 states, right? And I don't think we mentioned Fund 4 is only in 10 states right now. So 10 states in Fund 4, 31 states across everything that we're doing. So managing employees, that's complicated. Managing the assets, that's blocking and tackling, right? So what we're doing, we are looking for infill opportunities. Maybe there's a park that's 200 pads. and we want to add 25, 50 pads to it. We've got the land, we've got the space to do so, we've got the zoning. We're going to move forward with that. All of those kind of CapEx expenses, those value add initiatives, those are talked about and modeled before we even close on the asset, right? So there might be something that comes along the way, but the vast majority of this stuff is modeled out. So we're doing repairs to the roads, maybe a bus stop. We'll talk about that specifically here in a moment. We've got covered parking, things like that, and infill. Those are the really big drivers that
Yeah.
optimize revenue for us.
I love that. I mean, we're seeing this across the space, right? For those of you who are fairly new, value add is when you're not waiting for market prices to go up, right? For cap rate compression. It's when you're going in, we're executing a business plan that drives up value, right? We're driving up the net operating income, which is income minus expenses, and that drives the assets value up. So it's in our control. We in the multifamily space, we do this through, I think, in some of our recent opportunities, including with Spring Wind, we've done this through a property tax exemption, right? Sometimes we do it by going in with better debt terms, with a loan assumption, right? So we're getting very creative everywhere, and in terms of value add, which is where we don't have to depend on the market or cap rates for us to be able to drive up value. And so this becomes critical to the business plan, and this is why we love alternative assets because you actually have control. So, Ben, I'm going to move into the case studies, which will give you another opportunity to maybe deep dive into some of those unique value add opportunities. Let me know. I believe I have four. If you want me to skip through any or you want me to linger, more than happy to do so.
I could talk about these things all night long. Yeah, I love these assets. So you can see from the pictures here that those are real pictures from this asset in Wisconsin. It feels like a neighborhood, right? Big roads. This is an institutional quality park with nearly 300 pad sites. You can see on that NOI line, our NOI growth. We're pushing almost 200% at this point, 178%. Now that is coming from our pad site expansion that is coming from passing through utilities, right? So this place was never paying utilities, right? These tenants were not paying for utilities, so we passed those through. And then the rent here was significantly below market, nearly 50% below market. So we will slowly raise those rents over the years here. Now, we never want to exceed the quote unquote market rent. You kind of want to be at the average mark, and maybe slightly above average. You just don't want to exceed, because then you get into some iffy kind of ethical territory there. We care a lot about how we're presenting this. Our manager on the ground does a lot of educational material, and actually talks with our tenants, has a kind of community engagement. So we love that. So this park has been wonderful for us.
Yeah, and I mean, this is the beauty of acquiring from mom and pop operators and operating something at scale because you're able to go in, use the same systems over and over again, have those efficiencies of scale, and yeah, um,
I love
good
this
to
is
go.
this is actually my favorite one in all of our funds. So it's literally called Speedway Storage. So you can see in the picture the blue roof there. So it's a storage center. The previous owner was really into racing, and he built this speedway in back of his storage facility. Now we bought the storage facility and it came with this speedway. It came with all this land. Now we didn't know this going in. We kind of just, that land I think we bought for $1, literally $1. So we saw it kind of as a freebie. We didn't know what it was. Insurance premiums, we're not going to keep that a racetrack. We'll just sit on it and we'll sell this later on. Maybe we'll develop the land someday or sell it to a developer. Who knows? But we were focused on that blue roof right there. We're focused on that facility, which is a great facility. Room to raise rents. We really like this one. Well, lucky for us, Meta is building a data center down the road. And there's a lot of industrial development in this area as well. And so what we did on that, both in that middle section of the oval and on the actual raceway itself, that's now industrial outdoor storage. So we are generating a significant amount of income from these generators and backhoes and bulldozers that are being stored on that site that are building that giant meta facility and some other industrial facilities as well. We always are trying to think outside the box for, hey, how can we really pull this lever and maximize the amount of return that we can have? It's things like this IOS, industrial outdoor storage. It's not the main driver of what we're doing, but it's a freebie. It's an add-on, right? We've done cell towers at some of our manufactured housing communities, right? Where we have a little plot of land and we can lease that land to a cell tower agency. We've done solar on the roofs of some of our storage facilities. It's all these little things that those dollars really add up, and we're nimble enough and have the control that we can implement those strategies and get those dollars.
Yeah, and if you all these slides, these examples are in the slide deck, guys. If you go to gwcapital.com/ and Adrian, if you could drop those links in the chat /MHP Fund One, the number one, you'll be able to take a look at this. But we talk about how bumping up the NOI increases the value of the asset. If you look at this previous example, there's a value creation of about close to 12 million because of the NOI bump, right? So that's what we talk about when we talk about value add. I can skip through this, Ben. Let me know if you want me to pause on any of this, or we can come back to
This
this.
is, if you go back one, all I'll say about this is this North Dakota portfolio. This was actually three parks that we rolled into one park, right? So three 100 pad parks that they're all within a 10-minute drive of each other. We were able to buy them all, assemble them into one, and all of a sudden, this asset was not institutional quality. Now
Yeah.
300 pads, institutional quality. We'll continue the value add business plan here. But this is a great example of kind of that roll up strategy right there.
And as we're talking about that, I think this may be a great segue to go into exit options for the fund, right, Ben? So let's talk about, I mean, at scale, what our exit options are.
Yeah. So when we're looking to sell these assets, there's always the good old fashioned, a broker calls you, hey, I've got a client, they want to buy this asset. That's going to have to be the most compelling pricing for us to sell off a single asset, but we're not going to say no if the pricing's right. So that is an option. We're not going to say no to the onesie twosies. But really, our goal is to take properties like that North Dakota and take our Dakota portfolio or out of our fund too. We just sold the entirety of our Connecticut portfolio. These were seven properties that we sold to a New York City-based firm. And it's selling those off in mass, right? In portfolios of 7, 10, 15 assets at the same time. What that does is it strikes you a premium on all those assets together, right?
Yeah.
They're paying even more. It kind of multiplies your work a little bit, which we always like.
I love that. So guys, we talked about the return profile, right? When I say when you're doing due diligence and you're comparing multiple deals, you're always looking at the return profile and the risk profile. We talked about returns. We talked about how as GW investors, we're bumping your returns up, giving you enhanced economics, better splits. A lot of what we've been doing now is talking about how we've de-risked the deal, right? How are we lowering risk in the opportunity? We talked about diversification. We talked about the vertical integration and how that bumps up NOI. One thing we haven't touched upon is leverage, right? How what kind of leverage we're using, and in the when we talk about this, we'll talk about our single asset multifamily opportunities. The debt is like a big part of risk within the opportunity. So let's talk a little bit about debt. I believe I have a slide. Just want to make sure. Yep, we talk about exit options. Okay, let's talk about debt within the fund, Ben. And this I think this is a good segue to talk about that. And
Yeah. Yeah.
this talks to risk, right?
Yeah,
And
great question. And as of today, so we bought some new assets. And as of today, we're sitting just under 30% LTV. So that's where we're at today, is under 30% loan to value in the portfolio as a whole. Extremely conservative there. We want
yeah,
to land 55% LTV. That's our sweet spot. Still extremely conservative, right?
yeah,
Um, Now, the equation's a little different on the storage side than it is the MH side. The reason that's so low right now is because we generally on the MH side buy in cash on the front end, and then we put agency debt, so Fannie Freddie debt, on the asset after stabilization. What that does is that's a 10-year interest only note. When everyone else is in the sixes, all over the sixes, Fannie Freddie is down in the fives. right? And so it's really, really compelling for us. Not only that, we're such a heavy value add player that it's very helpful for us to, when we buy in cash and then we execute all of that value add within the first year.
Yeah.
Well, now this asset is worth way more, sometimes double what we purchased it for. So we can go out and get a 65% loan to value on the property itself, which is average for the MH side.
Yes.
But now that available cash, those proceeds, it's not our purchase price that we would have gotten if we would have put debt on day one. It is way more, significantly higher there. So that strategy is worth doing. On the storage side, that CMBS bank debt, generally we'll
Mhm.
put that on pretty early on. We don't, it's not as heavy of a lift on the value add side there.
Yeah.
So very conservative debt wise.
You made a few very key points, Ben, and I'm just going to pick on those. You talked about going in and paying all cash. Often that probably allows you to get in at a better basis, or are you going in with built-in equity, right? When you're able to buy things at a great price. I think something we always focus on is fixed rate debt. Okay, you're significantly lowering risk in the portfolio when you have fixed rate debt. And then like Ben said, I mean, the goal is to get closer to that 55% loan to value. The lower the LTV, the lower your risk is, right? So if you're at 90%, then that's significantly high risk. But these are very, very conservative numbers, guys. And those of you who've, heard us talk about the multifamily space, you understand that. But when we're talking about de-risking an opportunity, we're looking at the business plan, we're looking at the assets, the geography, but also at the debt. And this just talks to the safety of the business plan per se. Okay, I want to talk about tax savings. Everyone's super excited to talk about tax savings. And so the slide says it all, right? We're all very, very fortunate to have 100% bonus depreciation come back. So all these numbers are definitely juiced up compared to what they would have been if we'd stayed at 40%. It almost feels like it was so long ago, Ben, and we were all waiting for 100% bonus depreciation to come
I
back. But
know.
it was just this year that we learned about it. But with that being said, what I love about this when we get into this fund at this point is that you do get over 120% depreciation losses, but over time, right? So correct me if I'm wrong over here, Ben. So in 2025, because GW, because we're going in on the tail end, we'll be getting about for each 100,000 invested, you'll get about 20 to 30,000 in passive losses, and then you will get approximately around 50,000 in passive losses in year two and year three. And so for those of you who are looking at maybe exits at that point, or if you have other sources of passive income, so it is staggered, but it is significant, and that's what I wanted to highlight. And for those of you who have specific questions regarding this or how you're able to use this, make sure you drop your questions in the chat and we'll get to it. But I want to pause, Ben, and let you, add information if you want to.
Yeah, yeah. So our fund may be a little different than an individual asset, one syndicated opportunity. This is a really big fund, right? Our acquisitions are spaced out over time. We do cost segregation studies on everything that we purchase. Those are how we're able to pull that accelerated bonus depreciation forward, which is nice. These are estimates here. I'm hoping the situation is actually a little bit better for us. We do want to be conservative here, but there's an asterisk on this, right? It is an estimate.
Yes.
We do have two closes before the end of the year. So we're trying to close on these two. We'll do cost segregation studies there. That's where some of that loss in 2025 would be coming from, would be those assets as well. And then 2026, 2027, we'll keep doing these acquisitions, keep doing these cost segregation studies. And so we can expect this moving forward.
Perfect. Guys, we're getting close to the end. Next steps, timelines. Now, this is our fund is for accredited investors, and so you do need to meet criteria. And if you have any questions around this, we can chat. Adrian, if you could drop a link to the book a call in the chat and on Facebook for those who are on there, I think that'd be helpful. But in terms of timelines, we are looking, the deadline for soft committing is going to be next week, right? So if you want to reserve your spot, please go ahead and do that. We are actually close to 80% soft committed, so make sure you at least reserve your spot. And then the deadline for funding is going to be December 19th, so you have some time. And on our end, we're going to stop raising for the fund, at least for 2025, around the last week of December, so that gives us some time to aggregate our funds and have them placed. I wanted to round it off with maybe a little bit of comment about acquisition pipeline, Ben. I feel like you touched upon it, but if you want to talk about that, we can, and then we'll go to Q&A.
Yeah, well, you mentioned it earlier, 100% of the acquisition pipeline is MH, right? Moving forward. So we've got these three in the pipeline right now. We've got another, I think, six that are in either contract negotiations or LOI, so a letter of intent to buy. And in conversations, Matt actually traveling this week on the road, meeting with these owners. This is something that's unique, actually. I've just got to add this as an aside, is that um, we're not a small shop anymore. You know, we got 200 employees and we're in 31 states, and we've been doing this for, Matt's been doing this for 20 years. He still travels, our founder still travels to every single asset that we buy. That is a requirement for him. So the person who found the deal on our acquisition team, they go out there, they're the first person that's kind of interacting with that family normally. The asset manager who oversees the property management, they're going to go out there, and then Matt goes out there himself. So you have multiple sets of eyes on the ground at all these assets, and so it's a lot of travel, but a lot of fun.
Thank you. I just added some questions here that we've been fielding from others who I've hopped on calls with all week. When do distribution start? That's going to be the first distribution is potentially in January of 2026, right, Ben? The whole term, we're anticipating another around 7 years, right, from this point of entry. And the minimum investment amount for our fund is 50,000. Can you use IRA funds? We have a lot of our members who do use IRA funds. It does take a little longer to get the funds if you already don't already have funds in there, and for us to communicate with your custodians. And so I would say I start, soft committing and moving things along sooner rather than later. But if you don't have an IRA custodian and you want to be connected to someone, please shoot us an email. Even if you can drop this in the chat, admin@gwcapital.com, and we can connect you to IRA Club. We work with them closely, and they're very familiar with our fund, and they expedite things. So you have options there. Do I need an LLC? Again, this is a question I want you to go and chat with your attorneys if possible, and or your CPAs. But I will say that the majority of our members invest in our fund in their individual names, and I'd say about 25% use an LLC, and it is a personal choice. You do, as a limited partner, you do get limited liability protection through the structure per se. But again, please check with your attorneys to see what makes the most sense for you. We talked about this, do the GPs have equity in the deal? And we'll wrap it up and go to questions. Adrian, if you can drop any questions from the Facebook side in the chat, I would appreciate that. But and I'm sure these links are already in the chat. But we're a small enough group where if anyone has questions, guys, please feel free to raise your hand and we can take those questions. Let me also take a look at the chat. Let's see. Thanks for dropping those links in there. Oh, hey, Stephen. Nice to see you on here. So Stephen's question is, what is the fund's current IRR for each year since it began? I'm assuming it's just going to be based on the cash flow that people are getting, because I don't think we've had distributions. But do you want to answer that? The second part to that, Ben, is it below the projected IRR of 15 to 20%? And how does it improve over time?
Yeah, it is below the projected IRR because an IRR is just right now in the fund, it's just a figure, it's just a projection. You don't actually know the IRR until everything's said and done at the end, right? So that IRR is the time-weighted return, time-weighted average return for the life of the fund and everything that you're getting, including your proceeds, right? So all that net income that comes in at the end from profit. So right now in the fund, we had a ramp up period to hit the preferred return.
Yeah.
So the preferred return is it's a metric. It's just saying you're getting 100% of all profit until this preferred return number. Now we as GPs have decided it's too early in the fund to send out more than the preferred return. If we have extra income, more than the preferred return, we are reinvesting that back into buying new assets, into CapEx. That's available cash for us to use to magnify our total gains, right? That's what we're doing right now with excess cash. We have hit the preferred return mark. Year one, day one, we had no assets in this fund, right? So it wasn't generating anything. Investors who came in at that time were accruing preferred return. And along the way, we've had accrued preferred return, a catch-up payment, and then the current portion current payment, and we've gone up and up and up and up and up until we finally hit that preferred return mark. It took about 2 years to get to that point, which actually is earlier than we anticipated. We had more cash flow than anticipated to hit that preferred return mark, but we're paying the pref. That's what we're paying right now. Was that clear, Param?
I think so. I think, that's typical for most deals till you get to the point where you're getting return of capital and your profit splits return. Right till then, it's going to mirror the preferred return. And it's like I was saying, Stephen, and you probably know this because you invest in other multifamily assets. We don't even, with most multifamily assets in the current environment, with asset prices being where they are and interest rates where they are, it's very unlikely to hit preferred returns during the whole term, right? And it's more, you will have a component that is accrued. And we do try to get into deals where you're getting at least a 5% cash flow, but you're not going to see us getting to a 7, 8% cash on cash in most multifamily deals, and which is why this opportunity is kind of unique. But yes, once you start seeing those profit splits come in, that's when your IRR bumps are going to happen. And the second part of your question is about increments in terms of investments. Yeah, absolutely. We had someone today who funded from the IRA, and she invested 67,000. And I think it gets a little weird with IRAs. But yes, once you go above the 50, you can have increments. I believe it's in 5K increments is what the portal allows you to do. And Stephen's next question was the exact number for the preferred return arbitrage fee. Yes. And so because the fund at this point is hitting is at greater than 9-10% in cash flow, GW Capital gets the class where we get an 8% pref, and we're passing on the 7% pref to class A and B investors. If you're a class A or B investor, the arbitrage over there is going to be a 1% arbitrage in terms of the preferred returns, as long as the fund is paying out, is hitting pref, right? And so GW Capital gets an 8% preferred return and an 80-20 split. And then whatever you're seeing on the slides is net to investors, and the arbitrage in that pref is what GW gets during the whole period. I hope that clarifies that. Uh, I hope that clarifies that, Stephen. If not, you can text me. We can. Oh, I think you can edit the soft commit number. If you're having difficulties, just email us. I'll have someone from the team go in and fix that for you. No worries. Awesome. Okay, Idris, are there any other questions we have? Guys, anyone on here wants to just, unmute and chat, just feel free to raise your hand, and we can have a conversation. If not, perfect. Awesome. If not, thank you so much, Ben. Oh, perfect. We're at 6 p.m. PST, so at the top of the hour, and we'll call it a wrap. And then, guys, if you have any other questions, feel free to always drop it in. If it's on Facebook, if you want to send an email, admin@gwcapital.com, just feel free to email us. I'm more than happy to answer any questions. Thank you so much for doing this, Ben. I appreciate
Absolutely.
it.
Yeah, a ton of fun. Really, really appreciate you. Glad for the partnership. And yeah, thank you so much for your time, everyone.
Take care. Bye, guys. Thanks, Adrian.